Welcome, everyone. Casey Snyder and Tom Sedoric here, and we thank you for making time for our semi-annual webinar. The slide deck you're about to see can be found within our website at www.thesedoricgroup.com, and please do not hesitate to call or email any questions stemming from today's discussion. Our format will be similar to our webinar in February, and we will provide more detail on the subjects we recently discussed during our mid-year conference call. So first, we are going to look back and discuss elements of the past 6 to 18 months. Second, we will discuss some important themes for the year or years ahead. And then lastly, we'll discuss and review some of the actionable items we're in the midst of taking or plan to discuss with you this year. So with that, let's begin by looking back over the last 6 to 18 months and the 4 themes we want to highlight in this section. First, our message from March of 2020. Second, our science is awesome. Third, don't get caught investing with a rear view mirror. And lastly, chasing returns rarely works. And the quote here along the bottom is from a book we recently sent everyone, The Psychology of Money, and represents the importance of having a durability factor within everyone's plans or investment strategy. And this durability factor, or being financially unbreakable, as Morgan Housel puts it, allows for the ability to ride through downturns and capitalize on cheap markets without being reactive. And never was this more important than in March of 2020. So in March of 2020, at the onset of the pandemic, our message to everyone was to look out to the year 2022 and bridge the gap, meaning, now what do we need to do to help you get to the other side of this mess? Because in all likelihood, we'll be in some stage of economic recovery by 2022, and markets will likely front run the recovery by 12 to 18 months. And the chart here was within last year's presentation, and what you'll see is that we're right on track for a recovery within the projected timeline. And so far, we seem to be tracking in alignment with the U-shaped recovery. And the message here, and only with the benefit of hindsight, is that all recessions are scary, all have their own unique catalysts, but the world economy and markets do find their way back, which is why we need to be prepared for the unexpected, or unbreakable, as Housel puts it.
And remember last year when we showed you this chart, we had no idea what was going to occur in March or April. It certainly looks like we've had more of a V or U-shaped recovery. Is a W possible? It certainly is. But nonetheless, you can see out another year out, we'll probably be in a very serious recovery. And the markets, as Casey noted, are front running that.
Yeah, and that brings us to our second theme, which is that science is awesome, which what was so unique about this recession was how short-lived it was because of the global government intervention and a historical effort by the global scientific community. And we talk a lot about globalization and the interconnected global marketplace, but consider this. The vaccine introduced by Pfizer and BioNTech was developed by a Turkish couple leading a German company, partnered with a US multinational, led by a Greek immigrant with a Scandinavian chief scientific officer. Typically a downturn or recession can feel like an eternity, but due to science and the ability to create a vaccine in less than 1 year, this one was more like a long winter's nap.
And many of you know that I'm a bit of a history nut, and there's a historical connection with our neighborhood and that kind of globalization that Casey just described, people working all around the planet to come up with a solution. So for those of you that don't know it, one of the first transatlantic cables actually was terminated in Rye, New Hampshire, about 1.5 miles from where I'm sitting right now. And it was laid in 1874 from Ireland, encompassing 3,400 miles across the Atlantic Ocean. And now you think about where communication and globalization is today, and one of the first steps along that journey started right here.
That's old school. And this brings us to our third theme that we discussed in detail at the start of 2021, which was don't get caught investing with a rear view mirror. And in the beginning of this year, we cautioned everyone about believing that last year's winners, you can see down here, online retail, home improvement, would continue their historic run. And so far, many of last year's surging sectors or fund names have been this year's duds, while sectors like financials, energy, airlines that were crushed last year have been dominant performers year to date.
Many of you remember 20 years ago, we had this period called the dot-com bubble, and many people were chasing the dogfoods.com that made no sense whatsoever. And of course, that did not end well. So just what Casey just noted, which is the leaders of last year are not the leaders this year.
Yeah, and to add some more color on this subject, here's that famous quilt chart. This one dates back to 2006 and shows how various asset classes can go from last to first or first to last in any given year. And what you can see here is, momentum in 2020, the top performer, has so far been this year's laggard. And vice versa here, you have value of 2020 being the laggard, and so far this year, it's your leading asset class.
This is really very dramatic. I don't think I've ever seen a shift quite like that in my tenure. The recovery in value is a very healthy sign and a very good sign in the markets. And Casey will get into that a little bit more in a minute.
And the same message here, but this quilt chart represents global markets instead of simply the US. And what you can see here is that commodities and REITs were the bottom performers last year. So REITs are real estate investment trusts. And so far this year, they've been the top performing asset classes. To the surprise of many, emerging markets performed exceptionally well the last 3 months of 2020 to close out the year, actually second only to US small caps. What you can also see here is that fixed income performed very well in 2020, but the world of lower returns that we've been cautioning everyone about has officially arrived, and we'll go into more detail on this in a minute. But the point of these quilt charts is to showcase the importance of diversification and why chasing returns is so dangerous. And that brings us to our fourth theme as we look back, which is that chasing returns has rarely worked. And even though we all know that chasing returns is never a good idea, people do it anyways. And that's evidenced by the fact that household equity ownership is flirting with near record highs. And the previous record was set at the height of the tech bubble. Another example of this is how more than 10 million retail brokerage accounts were opened in 2020. And so far this year, just at Schwab, more than 3 million retail brokerage accounts were opened in the first quarter of 2021. That's more than all of 2020 at Schwab. And now part of this is attributed to low interest rates and historical stimulus efforts. But there's no denying the FOMO, the fear of missing out effect that's going on in what we call risk creep that's permeating within investor portfolios. And it's something we'll talk more about here shortly.
And remember that retail investors have typically been late to the party in other rallies. I don't know if that's the case this time around, only time will tell. But Casey, you mentioned in our team meeting on Monday some interesting research from, I think it was from Natixis, the big fund company. You mind sharing that?
Sure, yeah. So Natixis, large investment firm, they polled, I think, 8,500 investors to ask them what they expect in terms of returns moving forward on an annual basis. And the response was somewhere around 17%. So it's obvious that investors are piling in, expecting what has recently happened to continue, which is wildly concerning. So, and this brings us to our call it section 2 of today's discussion, which is important themes as we look ahead. And there are 4 themes that we want to highlight here: growth versus value, pent-up demand and inflation, low returns, tax and estate policy changes. And actually, we're going to touch a little bit on digital acceleration and cybersecurity at the very end here within our actionable themes. But the quote along the bottom is from a recent article in The Economist and represents how challenging it is to delineate one phase of the business cycle from another without the benefit of hindsight. And the point here is that there is a cycle. Nothing stands still for very long. So the first theme here as we look ahead is growth versus value. And for the better part of the last 10 years, growth has outperformed value. But this trend, as we just showed you within the quilt chart, appears to be in reverse, as value has outperformed growth over the past 9 months. Now, why is this exciting? Why is this important? Well, because value tends to pay higher dividends. And in a world of low interest rates, dividends are an increasingly important component of income planning for retirement.
And you can see very dramatically, I referenced the dot-com bubble. You can see what happened in 2000, that rough period, and see what followed afterwards was not very pretty. I view this shift as very healthy for the markets long term. I think value was kind of underperforming for too long a time, and I'm kind of delighted to see it recover. And as Casey noted, the dividends were typically from value stocks.
Yeah, and on a global scale, value becomes even more attractive, really for three reasons. The value-oriented sectors play a larger role in non-US markets. Foreign equities as a whole have underperformed their US counterparts and appear attractively priced. And then lastly, value overseas has a tendency to pay higher dividends. And again, that's very important for retirees and income planning. To give you a sense of the disparity between domestic versus overseas, you can see the numbers here. More companies overseas pay higher dividends. I think domestically, 2020, to be specific, I think 242 companies domestically cut or reduced their dividends in 2020. So it was a rough year for dividend payers. But so far this year, 76 have already reinstated them. We expect this trend to continue. But still, the majority of higher dividend payers are overseas.
And this is affectionately called a snowman chart for obvious reasons. But this is, if you take one thing away from today's webinar, I hope this sticks in your mind.
Now, changing gears for a minute, our second theme here as we look ahead is pent-up demand and inflation. And one of the most unique aspects of the pandemic from a financial perspective is how savings rates skyrocketed higher. And for better for worse, stimulus efforts and a partially closed economy fueled massive savings efforts. And eventually, this money seeps back into the economy and begins changing hands at a faster pace as consumption increases.
And quite anecdotally, we're seeing this in real time with many of you sending your friends our way to help them with their excess cash they've got built up. And the number of you that have called us in recent months saying, hey, Tom, Casey, I've got an extra $200,000, $300,000 over here. What are you going to do with it? It's been happening almost on a daily basis. It's fascinating.
Yeah, and so, I mean, we are seeing not only the accumulation of savings, but now we're beginning to see called the normalization of consumption. And so consumers are heading back out in droves, looking to make up for lost time. So Time Magazine referred to it as the Great Reopening, or whatever you want to call it. People are traveling again. Reservations are being made, and call it the investment in discretionary fund is back. And a couple of headlines here, you can see Alaska Air just announced that consumer spend levels are back or have surpassed 2019. United just purchased 270 jets. And even Delta said that leisure travel is back to where it was in 2019.
You need to see it firsthand. Just go to downtown Portsmouth right now.
And if you add all this up, so you have excess savings, which usually equates to increased levels of consumption, and add on to that the reopening of an economy while the global supply chain is still dealing with various bottlenecks like shipping woes or microchip shortages and a lack of housing inventory, and you have yourself a classic spike of inflation. But this recent spike has merely brought us back to levels that we've haven't seen since 2008, and many argue rightfully so, after historical stimulus efforts during the pandemic and on the heels of efforts by the Fed and other central banks following the Great Recession of 2008 and 2009.
And we rarely try to forecast, but one thing we will say that at least it looks currently that This is not a return to the stagflation period of the 1970s where you had double-digit inflation going on for years and years. This looks to be fairly temporal, and as Casey said, very normal.
And housing has been the poster child of supply-demand imbalances in a bottleneck supply chain. A limited supply of homes for sale met by soaring demand, followed by a shockingly high spike in material costs. And then you add on to that a huge labor market shortage, and you really have the perfect storm. And what you can see here is what $50,000 worth of lumber used to build you in, call it May of 2020, versus what it was building you of May of 2021. So really a pretty significant difference. But even the most, call it a wildly dislocated housing market, it is starting to show signs of slowing down as consumers begin to sort of back down and wait for some of this chaos to subside. And also the price of lumber. So after the price of lumber set record highs, you've seen it come down quite dramatically. And this is an important point. So supply and demand imbalances, especially those involving materials, have a long history of sorting themselves out over time. And it will take a while for the fall in futures prices to trickle down to your neighborhood lumberyard, but it is coming.
And many of you may have remembered the long gas lines and the oil shortages of the 1970s. And of course, today we're washing the stuff. So Casey's point about recalibration is spot on.
And this brings us to that question that everyone's asking is whether this recent healthy spike of inflation is temporary or more permanent. And we believe there's going to be this sort of coexistence of inflation and deflation, and have used the term coflation in the past to represent this unique landscape. So on one hand, we have deflationary forces like the digitization of industries or an aging workforce and structural labor issues. And then on the other hand, we have inflationary forces like a shortage of materials, roaring new industries because of technological advancements, wage growth, and job mobility. And this confluence of factors, many at odds with one another, may be responsible for why interest rates remain stubbornly low despite all of this headline concern over inflation.
Yeah, we coined this term coflation probably 2 years ago as we started looking at how our clients were living and some of the forces that were affecting their success and their balance sheets. You remember we referenced now stagflation once or twice. That was not supposed to happen in the 70s, but it did happen. So I think coflation is a very realistic term to be framing the current environment.
And stubbornly low interest rates brings us to our third theme as we look ahead, which is the dreaded message of lower than average returns are expected. So using Vanguard's 10-year capital market assumptions, what you can see here is that fixed income assumptions up here at the top are better than they were a year ago, but they're still pretty awful. I mean, we are talking about trying to keep pace with inflation here, hopefully. And then within the equity space, down on the bottom, projections are respectable, although they're still below average. And all of this adds up to a balanced portfolio delivering below average returns at a time when we just discussed investors are piling in with the hopes of continuing this epic market rally. And our fourth and final theme here as we look ahead are tax and estate policy changes. And with returns expected to be lower and taxes higher, we continue to express the importance of tax efficiency in the years ahead. And I'm not going to go into detail on this right now because there's too much uncertainty about which element of which proposal is likely to pass, but we're certain tax and estate legislation in the coming years will not be more favorable than it is today. So a lot of our efforts today revolve around preparing for a less tax-friendly world.
We hope this chart isn't news to any of you. I think we've shared it with you before.
And this brings us to our last section involving actionable items, given some of the risks or opportunities and themes as we look ahead. We have risk creep and rebalancing, tax policy related action items, estate planning, and then balance sheet protection and cybersecurity. And so the first one here is that concept of risk creep. So given strong performance within equities over the past 10 to 11 years, especially within growth-oriented investments, many investors have more equity exposure or volatility within their portfolios than they intended or can afford. And this sort of creep is common over time, and it's often enjoyable as long as markets continue rewarding risk. But this makes it easy for investors to justify maintaining a higher risk profile without realizing how close they are to causing themselves great harm. And eventually, risk works in the opposite direction. And unless risk exposure is rebalanced strategically over time, it becomes dangerous. So for all of you on today's webinar, if you haven't already, we will be discussing risk creep with you and whether rebalancing efforts are warranted. And sometimes these rebalancing efforts may trigger a taxable event, and the taxation of these efforts should always be evaluated. But fortunately, today's tax environment is very advantageous for realizing gains.
And I just want to restate that we view this shift from growth to value as a healthy shift, sign of a healthier market. It's broader, and that is a good thing.
And this takes us to our second actionable, call it subject matter, which is tax policy related items. And right now, a large amount of our time behind the scenes revolves around creating current and future tax efficiency, which is specific to each individual and family circumstances. There really is no one size fits all when it comes to planning for rising taxes because of how tax policy changes impact everyone differently. So we'll start here at the top. Okay, the idea here is realizing gains. Well, realize gains today if you're in need of funding short or intermediate term goals, and or what we just talked about, rebalancing to avoid risk creep. Also, take a look at your current tax exposure, maybe versus projected tax exposure. If you expect a couple of big earnings years, maybe it's still prudent to realize some gains now versus later. The second item here is Roth conversions. The idea here is we're converting traditional IRA savings to Roth savings so that future earnings and growth will be income tax free. And even if you're not on the doorsteps of retirement, saving for a Roth conversion strategy, saving for the tax consequences of this strategy may start years in advance. Third, we have harvesting tax losses. So this is when you sell securities at a loss, you capture that loss to offset future gains. And this is why March of 2020, from a financial perspective, was such a blessing. We were able to realize losses for the first time in a long time. Fourth here, reevaluate saving strategies. So which combination of buckets, pre-tax, post-tax, and Roth, make the most sense to contribute to within the context of your tax situation today versus your projected tax situation of tomorrow. Deferred compensation, look, it's a matter of if taxes are expected to be higher later on, it may not be a good idea to defer taxation into the future. Maybe you pay taxes on earnings and income now versus later. And then lastly here, we have qualified charitable distributions. The idea here is to use your IRA distributions, your required IRA distributions, your RMDs, to fund a charitable goal. And by doing so, you fulfill your charitable intent while also creating some additional tax efficiency.
And we'd also like to remind you, as we have in the past, that taxes are in fact your single largest lifetime expense. So stay on the good side of your accountant, take them to lunch, at the very least send them a note and thank them for what they've done for you in recent years, because their careers have not been easy ones.
Yeah, and that brings us to our third slate of actionable items, which involves the world of estate planning. And the bottom line is this: the estate planning proposals being discussed today would require a complete review of everyone's estate plans. The elimination of the step up at death would trigger a slew of action items like gifting strategies, strategic realization of gains along the way. So an example of this might be if mom and dad are 80 or 85, they're in a very low income bracket versus their kids who may be in a higher income bracket. Mom and dad own a lot of low basis stock. it may be more advantageous for mom and dad to start realizing gains in their 80s versus having those securities flow through to the kids at a time when they'd be subjected to 37, 40% tax rates. And then there's also the strategic use of various trusts. And then moving into the lifetime gift exemption, today it's at 11.7 million, but it's expected to revert back to 5.85 million at the end of 2025. But various proposals are requesting or asking for a reduction of the lifetime exemption down to 3.5 million. And it's common for families in the 3 to 8 million range to ignore the lifetime exemption of 11.7 million because it may feel so far off. But if the lifetime exemption is reduced to 3.5, many of you on this webinar will suddenly need to review your estate plans and may require something a bit more elaborate. So some things to consider, larger gifts in 2021, make sure to continue to use the annual exemptions. There are various trusts that may be in conversation. And then lastly, for those that are charitably inclined, the usage of donor advised funds in particular may be something that you want to speak to your accountant, to us, as well as your estate attorney about. And then our last actionable item today really has nothing to do with markets, but everything to do with protecting your nest egg. So the first here is the need for improved cybersecurity. Now, our lives are increasingly digital, and from the looks of it, our digital footprint is only going to expand in the coming years. And Raymond James conducts a lot of due diligence within the world of cybersecurity because of how important it is to help protect clients from fraudsters, and is actually on record recommending 2 firms for password protection amongst a host of other offerings. And these 2 firms are listed up here at the top. You see Dashlane and LastPass. Please feel free to look them up, email us, and we can send you the links. But here are 2 services that you may want to look into. We often get the question of who would you use? Well, here are 2 names now. And the second part of needing to protect your nest egg is the importance of reviewing your insurance coverage. And what we're talking about here is your personal lines, your property and casualty insurance. Yes, we know that this is very boring, but a lot of you have a much larger balance sheet today than you did 10 years ago. And your risks may have evolved. And many new policies today may even include or offer a cybersecurity coverage clause to a certain extent. So now's the time to be looking into your insurance coverage. Now's the time to be looking into how you're going to protect yourself from fraudsters out there.
Good advice.
And that brings us to the end here. So to conclude, going into 2020, we spoke about the fragile nature of markets and needing to be prepared for the unexpected. And by no means did we know a pandemic was around the corner, but we were prepared for the unexpected. And today, now that we're caught up and have helped our clients and their respective accountants and estate attorneys through what's been a brutal tax and estate planning year, we are getting back out in front to prepare for the next unknown event. And it may be a dramatic adjustment to tax or estate legislation. It may be that low interest rates remain lower for quite a long time. It may be the resurgence of inflation. It could be the roaring 20s or a repeat of, or it could be the opposite, where we experience a lost decade in US equities. But no matter what, we want to make sure that you're prepared and that your comforts, your financial comforts and success don't depend on elements beyond our control. So with that, please feel free to email or call with any questions, and we appreciate your time today.
Thank you for joining us. Thank you for viewing this webinar. Feel free to share this. It is compliance approved, and you're welcome to share with friends and family as you deem appropriate.
Thank you.
Thank you.